Good morning, everyone. Greg Taylor here from Salter Brothers. We'll make a start in 1 minute. We're just waiting for a couple more to join, and we'll make a start. But thank you for your patience. Okay, I'll make a start now. So, good morning and thank you, everyone, for taking the time to join. Today's a monthly webinar that we're committed to for the Salter Brothers Emerging Companies Limited vehicle, the listed investment company SB2. What we're looking to do is each month to provide a bit of a deep dive into a specific topic to share a little bit more about the fund and how we operate and how the fund is constructed and the thinking behind some of the key decisions in which we make and the ultimate portfolio construction. There will be a recording of this presentation, which will also be made available. And from that, there's also the facility to ask some questions as well, which you can type into the box. So the presentation you see here has been released to the ASX, and there's a copy of that, and as I said, will be shared following to all attendees. Moving into what we're looking to cover today, so we'll provide a quick update and overview of Salter Brothers and the SB2 fund, and then we'll jump into an overview of the recent reporting season, and then we'll use that broader thematic and focus to dive into how the Salter Brothers investment team manages the portfolio during reporting season, and then we go into a couple of live examples of some recent results and how we thought about and responded to them in making up the portfolio. So again, just a little bit of a recap on Salter Brothers, global fund manager with over $3.5 billion of assets under management, and they're split across the property, credit, and equities asset classes. And the particular product in which I manage and am responsible for is Salter Brothers Emerging Companies Limited, SB2, which is a listed investment company, which we focus on investing in companies listed on the ASX with a market capitalisation of under $500 million. Again, quick introduction to myself, Greg Taylor, is the lead portfolio manager of the fund, and head up the equities business within Salter Brothers. Really fortunate to have a large and experienced team supporting me, and it goes as far as saying it's one of the largest and most experienced teams, in this end of the market in the Australian small cap space. So very fortunate there. SB2 as a fund has over a 3-year track record now, and really strong performance over that period, and more recently also. One factor we've spoken about in the past is that the SB2 share price trades at a discount to the underlying post-tax net asset value of the fund. That creates an arbitrage opportunity for investors, and at the moment, or as at the end of August, that discount was 37%, which is very large, and we'll talk to some of the initiatives at the end of the presentation on what we're doing to close that discount. And the most recent research piece that we did and webinar was on the relative valuation of the Australian small cap equities versus their larger cap peers, and spoke at length about this quite unique time in the cycle where there's been a significant disparity of returns over the last 3 years, creating a really large valuation differential between large cap and small cap equities. And we continue to be of the view, and especially following the recent reporting season, that the risk versus reward opportunity for small cap investing over the next 12 months versus large caps appears very attractive. When I set the topic for today's webinar sort of a couple of months back, the intention was to talk about in depth the recent reporting season, and just to define what is the reporting season. And what I'm referring to is it's when, from an Australian context, the listed companies on the ASX, they release their financial results for the 12 months up to 30th of June. This typically takes place during August, and there's quite often the actual results are released, where the market takes a big focus on about where those results landed versus expectation, but there's also a large focus on the outlook statement and the current trading conditions for those companies. So quite often it's a very instructive time of the year, because there's a lot of new data points and a lot of insight and opportunity to meet with management and competitors within the space to form a view on the outlook for the next 12 to 24 months, which very much drives share price performance and valuations over that time. So in Australia, the August reporting season for the 12 months to June is typically the most significant. But if you look at the US, where they don't typically have a June 30 year end, so they're typically quarter end or 6 monthly updates for the US market. So still important in the US, but not as significant as the August period for Australia. Though in saying that, the recent reporting season, both in the US and in the Australian market, didn't really flow out any new trends or significant themes from a bottom-up perspective for the underlying companies. Yes, there was a lot of one-off winners and losers, and as the typical volatility that is found during the reporting season, but there was no real consistency, and the reason for that was it was very much overshadowed by the broader macroeconomic factors happening in the market. And so what you saw in the early part of August was there's a couple of sort of global data, macro data points that came out that really spooked the market. The first one was US, whereas the market had been quite optimistic as they were starting to head into a interest rate reduction cycle and inflation being under control. All of a sudden, the US macroeconomic indicators surprised the market on how soft the broader US economy was in early August and for the prior months leading into that. And so all of a sudden there was talk of, is the US going into recession, and what does that mean for capital markets and equity valuation? So that really dominated thinking in the early part of August. The other sort of external shock, I guess, was what we saw in Japan. And Japan's typically been quite conservative with their monetary policy, and they're setting their interest rates. They started increasing interest rates pretty significantly as well, and that spooked the market. And what we saw was movements up to 10%. Like, in the global markets, so 5 to 10% falls in the global market. So irrespective of what was happening from a individual company reporting, that was being overshadowed by a more global view on the direction for markets. But what we saw was by mid-August, the market had that sort of 5 to 10% adjustment, and then started focusing on the US as they were heading into their interest rate decision, which ultimately was a reduction in interest rates, and pretty strong indications that's going to continue for the significant period going forward. So then markets are rebound. So what you saw was extreme volatility. The first half of the month was down, I said, 5 to 10%. The second half of the month was up 5 to 10%. And so for the period, the broader market performance, both in Australia and the US, was relatively flat, but was, as I said, a lot of noise in between the two data points. And it really overshadowed, again, typically you have themes like where certain sectors outperform, or large caps or small caps perform, or value or growth bias might have a different sort of thematic coming out of reporting season. But there really wasn't any strong changes to previous trends. As I said, the first half of the month was different to the second half of the month, and so a real bit of a non-event from that perspective. But I guess in a good way, from the bottom up view of all the companies reporting, was there was no major surprises across the board. There was obviously individual surprises, but what that meant was that we didn't see any significant change for the outlook over the next 12 months, which is a positive thing in my mind, because the market has been performing quite well. It's quite optimistic about the growth outlook, and the fact that didn't shift too dramatically, I see as a positive. One data point that I think is relevant, and I spoke about in the last webinar, was around how important interest rates are in determining small cap returns. And so we saw the US go first with their first reduction only this month, and then increasingly data out of Australia is indicating that Australia's probably unlikely to do it this side of the end of the year, but January, February looks like the period, most likely February, that you might start to see rates come down in Australia. So I think that'll be a good catalyst for markets. But we spoke about this differential between small cap and large cap companies. And I'll speak to you shortly around the growth outlook for our portfolio and having greater than 20% earnings growth expectations going forward. Whereas the ASX 100 post the reporting season, the consensus expectations for earnings growth over the next 2 years was below 4% per annum, which is pretty mild growth when contrasted to what's on offer in the small cap space. So really continue to believe that with interest rates coming down and the growth outlook being significantly more positive for small caps, we're really going to head into a period of positive performance for that sector. Okay, as we jump into more specifically the Australian small cap market, it really is a dynamic across 3 months. So, whereas the US and the ASX 100 companies just released one set of data in August for that 12-month period, what you see in small caps is it's really the information spread over a 3-month period. It starts in July, where a lot of the companies report their unaudited numbers, but also their cash flow results, which are so critical as the market continues to be focused on balance sheet and cash conversion of earnings. And so you start to get a high level view of how the company's performed over the last 12 months in the month of July. Then as you roll into August, what you see is the audited, detailed financial results are shared, and typically a bit of an outlook statement on what they expect for the next 3, 6, 12 months for earnings. So it's a critical one. But then in September, you have all the management teams of the companies that have released their results doing what we call road shows. They come out and meet investors, and you have the opportunity to sit down with the CEO, CFO, and quite often a board member of the company in a one-on-one basis to really dive into their recent results and, more importantly, the outlook. So what I'm going to talk about is what's transpired for the portfolio and the process we go through over this 3-month window, which is really critical in informing the portfolio in which we construct it at SB2. And as I said, I'll talk through some individual results as well as, more importantly, the process, which is critical to getting those repeatable returns. Pleasingly, the portfolio has performed well over this key 3-month period, which as a portfolio manager, really you can get a lot of noise in other months when there's not a lot of data being released, but it's during the months in which key data points are released you hope to do well. And pleasingly, we've done that, and again this month of September, continuing to have positive performance, which is encouraging. And here's just some of those performance numbers. Just to keep in mind, these are as at the end of August. Obviously, we're at the last day of September today, and these will be updated in the next week for the month of September. But what you can see over the last 3 months, we had quite significant positive performance. Whereas the market had been down, we're up over 8%, which is a relative outperformance of greater than 10%. And again, what I can point to is the month of September's been positive also, which is encouraging. So I'm going to step into the process now, and I think managing small caps is complicated, right? Because there's a lot of things to consider. There's a lot of companies, there's a lot of data points, but there's also the consideration of liquidity, and smaller factors can have quite large impacts on share price performance. So what we do as a team, so we're fortunate to have a team of 6 people focused purely on this product, is that, and remember, we're investing in companies under 5 listed on the ASX, starting position under 500 mil market capitalisation. So we leverage a large network of brokers, advisors, industry experts, operating partners, and our own experience to identify a basket of stocks which we will consider an investment in, and that number's greater than 100 individual companies within our investable universe, in which we will meet with the management, screen the companies, and do detailed work. After the first screening, where we meet management, do a high level financial model, and check the relative valuations, we form a view on whether we think this is a likely to be a candidate to find its way into our portfolio. And what there is of that universe of over 100 stocks in which we do that work, just over 50 of those pass the first screen, and we do very detailed work on those 50 companies. And what that detailed work involves is a really disciplined process. And so, investing and analyzing small caps for over 25 years over my career, this discipline and depth of research is critical in delivering repeatable performance. And so a big body of the work is around the financial modeling. What we do, we look at the historic earnings, but more importantly, current and forecast earnings in the income statement or profit and loss statement. But we also do a lot of work around the balance sheet and cash flow, because as I'll talk to shortly, some companies might have good income or profit and loss statements, but doesn't necessarily convert into strong cash flow, or they may have issues with their balance sheet. So it's really important to do detailed modeling around that, and we do accurate and a lot of work on. We take a 5-year view on future earnings, which obviously a greater focus on year 1 and 2, but all the way out to 5 years, forming a view from the bottom up on the direction of revenues, costs, and earnings, and how that flows into the balance sheet and importantly cash flows. Once we do all this work, again, this is done by meeting with the company, typically 3 to 6 times minimum, in forming this financial view and also qualitative view of the company, and we also meet with competitors of the company as well to get a broader perspective. But once we've done this work, really important into our process is the valuation work. We're looking for growth, quality companies, but at reasonable valuations, which have meaningful upside to valuation. We undertake cash flow and discounted cash flow analysis, as well as earnings multiple analysis, which forms a view on not only the quality of earnings and the quality of the company and the opportunity ahead, but where it sits in relative valuations. We mix all that in together and create the portfolio. Of the 50 new companies or companies currently not in the portfolio of 25, 13 of those came out of that process, which get to the next level of the process, which they're the top 13, call them watch list or reserve holdings. We then do an additional body of work on and contrast to our existing portfolio holdings to form a view on whether they should displace one of the current holdings. So that's what we do. That's what we do time and time again. So we model over 100 companies. We, in the last month or two, we've met over 50 of them and done this detailed work, and we'll do the other 50 over the next month or two. But it is a deep dive. But we've got a really disciplined and detailed process we do on the day of the results and as they come out. So I thought I'd share that with you just to really get an understanding of how we go about it. So I spoke about this being a 3-month process, but whenever there's a major data point released on a company, first we speak with all the companies and understand what day they're releasing the results, and so we can prepare for that. We've got a team of 6 where we divide and conquer, make sure that we have a dedicated person to each individual company, who's the primary analyst on that company. And but then once we start getting into company meetings, we normally get a minimum of 2 to 3 members of the team involved in those forums as well. But so once the company releases a result to the ASX, within 15 minutes of that, the primary analyst will do a quick screen of that result relative to our expectations. They'll do a snapshot where we've got an earnings metrics and broader metric table, which is we contrast where the result landed versus our expectations and the expectations of the broader market. So what that enables us to do is to be across it, and if there's any positive or negative surprises or any new information in that data release, that we're there and we can prioritize where we spend our time on the day of these results. Because what's interesting is, in many instances, we'll have 10 different companies releasing their results on the same day. And so where do we focus our time, and how do we divide and conquer that? Again, we have a dedicated analyst and work out where to do. So in addition to doing that initial screening, there's typically the company will do a public presentation, a little bit like this, a online webinar. We'll ensure that we've got at least one member of the team on that and listening into the group forum to get the additional colour around the data that's been released. But in addition to that, ahead of time, so the weeks leading into the result release, we schedule a 15-minute one-on-one call with our key management teams of the portfolio holdings on the day of the result. So we've analysed the result that's been released, we've listened to the group forum, but then we like to have a 15-minute call with management just to get verification on any aspect that wasn't entirely clear from the initial analysis, and also to dive into any new data points or surprises that might have came out. So really important discipline to make sure we're across all the issues and our interpretation and assumptions of the data points are accurate. And where this is really important is, and I've given an example here on the right-hand side, one of our key portfolio holdings is a company I've spoken about previously called AI Media. What we saw, again, a company we know really well, we've done a lot of work, we had expectations around where the earnings would land and what the outlook or forecast statement would be. That result came out and was exactly in line with our expectations, and if anything, maybe slightly above. Despite that, and us having the conviction on why this was already one of our top holdings in the portfolio, the share price dipped up to 15% within an hour of the result being released, which made no sense to us. We knew the company, we checked the data, we listened to the forum. It didn't make sense. So we actually brought over 1 million shares at that, or a couple of million shares actually, at that price, more than 10% down immediately after the result, because it just didn't make sense. And we had the conviction. And ironically, by the end of that day, the stock price was up 15%. So you had a 30% movement in the share price on the one day. And us being across it, having the depth of knowledge, being across the data early and responding, enabled us to have a 30% return in one day on those shares, which is pretty unique. Doesn't happen all the time. We're not active traders, but the reason we do this is to take advantage of opportunities such as this, and it can go the other way, right? Sometimes a company can disappoint and the share price goes up, and it gives us the ability to have that information advantage and knowledge to take advantage of such opportunities. The last part of the reporting season or process that extends into, so July, you've got the unaudited high-level numbers and cash flow. August, you've got the detailed data points and outlook. September, you've got this thing called an investor roadshow, where you have one-on-one meetings with the company over the course of at least an hour to really do a deep dive and test your thesis and outlook. And so we do that over the month of September. And again, over the month of September, I think at latest count, we're closer to 100 meetings we've done with the companies. So that's the process. And I guess the point, really wanting to leave with the audience today is that small caps are tricky to invest in at the best of times, especially during reporting season. Having a large, experienced team with a really disciplined, detail-oriented process really gives us a competitive advantage to take advantage of the inefficiencies in the market, which are still there. And why small caps are so interesting is that there's a lot less people doing this depth of work, and I think you could count almost on two hands the amount of people doing this depth of work in this timely nature in the small cap market. So that gives us a competitive advantage. Contrast that to large caps or global equities. There's dozens, if not hundreds of people doing this level of work, and it's really hard to win because it's a lot more competitive market. So the inefficiency of the small cap market continues to, we think provide a return for the effort that our team puts into this. And quite frankly, it's almost next to impossible to replicate on an individual basis. You need a big team, you need this process, and an individual investor, would really struggle to match this level of work. Look, I've deliberately spoken about 3 companies here, which I spoke about in the recent presentation, but I'm just focusing purely on their results, and 3 contrasting results from our key holdings, which again just highlights in some ways the inefficiencies of the market, but also the opportunities that is created. Firstly, I've spoken about this Alfabs. It's only recently listed on the ASX and doesn't have many people following it. We took a pretty meaningful position in the fund and are very optimistic about the outlook and the relative valuation of this company. What it does engineered solutions for the civil infrastructure market. So it designs projects for road, rail, airports, key government-backed civil infrastructure projects where there's a lot of work going on. These guys have got a really proven track record of delivering projects successfully into that space. The other half of the business focuses on doing asset hire and machinery maintenance into the coal sector up in the Hunter Valley. And they've recently won some very significant contracts. One of note's the Malabar contract up in the Hunter there, where our analysis suggests that there's at least $10 million of new earnings coming as a result of those recent contract wins. So this is a company that put out prospectus forecasts earlier this year and comfortably beat their numbers. Over 10% higher. The actual numbers came in for the FY24 year versus expectations. And ironically, the share price didn't move. And that's because it's a relatively new company. There's not many people looking at it. So in the busy time of reporting season, we've had a really high quality company trading at very attractive valuations, beat their earnings expectations by greater than 10%. The share price didn't move. So to us, that's exciting. The outlook is as strong as we hoped. The number was stronger than we expected. And if our forecast valuation of this business increased as a result of all these data points, yet the share price didn't move. So we've been in the market just topping up that holding and are increasingly confident about that. So there's one extreme of an example of what happens in reporting season. The next one is a disappointing result from reporting season. And again, I spoke to this Close the Loop circular economy company that looks after packaging and plastics recycling, but more importantly, and of note to us, does refurbishment of electronics products. And so, think laptops, phones, printers, etc. These companies, repair and refurb businesses there to save them going to landfill and get quite an attractive return on that. So that company that had hit its earnings forecast, but its cash flow result was very poor. Share price declined greater than 20% over the reporting period, which was very disappointing, but it really forced us to retest our thesis. We had the multiple meetings with management. We did a lot of work around the cash flow conversion and balance sheet, and actually went as far as meeting with the chairman of the company to express our concerns and wanting to understand what remedial action they were taking to ensure the company delivers on its potential. Following that process, over that 3-month period, where our investment thesis continues to hold, and we haven't started buying more shares, but our view is that the market probably overreacted on the soft cash flow result. Yes, it was disappointing, but did it justify a 25% share price decline? We do not believe so. We think the board and management team have heard the feedback from from the market and have taken the appropriate action to instill the confidence of the market going forward. And the broader macro investment thesis around this significant growth in electronics recycling, they're very well placed to continue to benefit from that. So it's a company that a lot of people panicked. There's two large institutions that sold their entire holding at very low prices, which forced the share price down. But we think at the current price, the risk versus returns in our favour. And then just conscious of time, I've already spoken about AI Media. That was that graph earlier, largest portfolio in the holding in the portfolio, had quite fell on the day of the result. We topped up the holding and it dramatically, after we didn't buy any, pushing the share price up. But once everyone truly took the time to understand the result and the outlook statement, the share price has performed very strongly during the months of August and September. What we have here is just a snapshot of the portfolio. Again, really excited that after we've updated all our numbers and our thesis, we've got a portfolio which has revenue growth forecast to be greater than 20% over the next couple of years. Contrast that with the ASX 100 companies where it's less than 4% growth. And these are profitable companies trading on EBITDA margins greater than 16%, but earnings multiples or valuations in single digits, less than 10 times PE. So really excited and optimistic about the portfolio of the 25 holdings that we've got that have got these characteristics. And just to finish up, we are working on closing the discount to NTA. We've spoken about this dynamic where the underlying asset value is worth a lot more than the current share price. And we've continued through the month of September to be active with our buyback. You can see that there's been additional initial buying and we're continuing to do this marketing, the webinars and the marketing to get us to where we need to be. So we've seen a lot more buying come into the stock, and now we're confident that we'll continue to close that discount. All right, well, I'll pause there and see if there's any questions. And from that, but if you have any questions following this, my contact details there, please feel free to shoot me an email and or Yossi, our head of distribution. We'll be happy to take any questions. But I'll pause now and see if any questions have come through the chat function. Megan, are there any questions? Can you just read out that question, Megan, if you could for me, please?
Yep, it says, what is the current strategy and criteria for liquidating underperforming allocations within the portfolio? Additionally, how do you assess the timing and impact of these divestments on overall portfolio performance?
That's a great question. And one of the most difficult aspects of small cap investing is managing your winners, but also managing your losers and cutting your losses when appropriate. We spoke about close the loop as an example of, is that one that the thesis no longer stacks up and you want to sell? But the other consideration is around liquidity. And again, why a professional team and professional management is really important in small caps is because even though the thesis may have changed a little bit and you may not be as confident in the outlook for the company in which you're holding, there may not be the liquidity in the market to exit that position, or it may not be optimal for the portfolio to try to force a sale of that. So you need to work really hard understanding where the flows are, what brokers have got the flows, who are the holders of these companies, and trying to do block trades to increase or decrease positions. And And but we were quite active with our trading over the last couple of months. We have sold down in quite a number of positions, and we've also increased a number as well. And a couple of new names have joined the portfolio, and a couple have exited. So it's really I can't talk in too much length or detail about that because a number of them were in the process of either increasing or decreasing our position, and it would put us at a disadvantage if we let the market know we're actively doing that. But I can assure you that there's been quite probably a little bit more than normal turnover over the last couple of months in the portfolio, but and we're continuing to manage that. And we've got to balance the risk versus reward as well as the short-term impact of that trading. So it's we're comfortable with where we're at. We a couple of the companies maybe not have the liquidity at the moment that we would require, but we've done a lot of work in understanding the register and the brokers and what the exit strategy may be, and we're continuing to work through that. As again, good question. If you wanted further detail on that, please feel free to reach out separately, but hopefully that answers the question. Megan, was there any further questions at this stage?
No, that's it.
All right. Well, thank you again, all. Appreciate you taking the time to listen. Again, we'll are recording this. We'll make a recorded copy available to via all our platforms, and we can take it from there. But my details are there. Always welcome any opportunities to engage with our investors or potential investors. So we look forward to hearing from you. Thank you again, and goodbye.